Yeah, reliability, low risk, yeah. Consistency. So do we think that a high win rate, is a high win rate critical for our system? Is an absolutely high win rate critical for our system? Do we need something that's running at least 70%? How many people here have heard of the the rule that it has to be over 70% for it to be any good at least? Yeah, excellent, good work. So we're all on the same page. Excellent. All right, so that's one of the myths of trading, and obviously with new traders, that's one of the things that you get caught up on a lot. You've got to make sure that you have what we call a positive expectancy. So we'll talk about that at another time. But basically, win rate isn't as critical. We need to have that good reward to risk. So we want to make sure that if we're taking a trade, we're not just going for one-to-one all the time. Like if you're risking $1 to make $1, things like slippage, brokerage, fill rates, execution, they're all going to impact on your ability to trade the market. So if you get a situation where, there goes the bell, if you get a situation where you've got, 2 or 3 months where the market's flat and doesn't do much, and you're getting, say, a negative result on your trade plan and your system, you're going to get chewed up on brokerage, and that's going to really impact, and particularly if you get lighter volume or you get a little bit more slippage in the market, that's really going to impact on your performance. So what we need to do as traders is be thinking about how we can develop an edge in the market, not only just from obviously a good win rate, but also the critical thing there is having that skewed reward to risk. So coming back to expectation, accountability, it's really up to us as traders, isn't it? That's part of our accountability, to make sure that whatever we're doing as part of our trading, it comes back to us being accountable to make sure that we have taken ownership of the strategy we're trading, that we do have an understanding of that necessity for a superior reward to risk. That's our responsibility ultimately. So let's continue on here. Now, good trading systems have a positive expectancy, they have an excellent reward to risk, and they have developed within the system, or part of that system has money management and position sizing, because as traders we don't really want to be just trading markets where we're just working an edge. We want to be able to capitalize on the edge that we have, and we've talked about it in the mentoring program. We want to take advantage of our edge by applying a money management strategy that gives us what we call geometric growth, so the ability to grow our account exponentially. Now, you're not going to get that if you use what we call a fixed fraction money management strategy, because the reality there is that if your rule is that you need say you're applying 1% per trade, 1% per trade. So say for every $10,000, you're risking 100. You're going to have to, and if your contract, so say your maximum risk is $100 on your trade, then for you to trade 2 contracts, obviously you're going to have to double your account. So while it does manage your risk in your strategy, it doesn't at all deal with the potential of growing your account exponentially. So one of the things we need to understand as traders and build into our trading system is the ability to not only have a money management plan, but also have some type of position sizing strategy to take advantage of our edge. So we'll just move through here. So a couple of the things when we start trading a system, and we're talking about obviously the profit accelerator here, it's critically important from the outset of trading that we manage our expectations. So one of the things there is that we need to know exactly what that means for us. So expectation is something that most of us obviously, when we first start looking at systems or trading, the first thing we do, which is kind of a little bit of a habit for most people, is we look at straight away the equity curve. We look at how much money it's made on its best run. We look at its total number of points it's made. So that's really just, I guess, human nature. You're always looking at what this system can give you, or what you can get out of this system. And that's one of the things that we've got to be a little bit careful of when we're looking and assessing systems. We just need to make sure that we manage our expectation from the outset, and that part of that process is to go through and critically analyse the strategy or the system that we're looking at. So a couple of the things I wanted to go through today, obviously, is we're trading crude oil. We're trading the profit accelerator with crude oil initially. Obviously, we're going to be looking at developing up other markets, and there's obviously some fantastic opportunities out there. So we're working on that at the moment. But with crude oil, how many of us, we've got this system, how many of us actually do know what the market you're trading? How familiar are you with crude oil? Do you know what its average daily range is? Do you know what its average volume is? What's the maximum number of contracts you'll be able to trade before slippage and fill rates become an issue? Does a range affect the system performance? What typically happens on low volume days? Does crude oil have cycles, price and time? So these are some of the questions that we need to know as traders when we start to trade a system and trade that system on a specific market, because you may have been trading a momentum-based system or a counter-trend system, and with a counter-trend system you may not have been really too worried about the average range or the volume, but there's some of the things that we may want to basically look at as far as the as far as what we're doing. We come back to that top component of expectation, accountability and ownership. It's all well and good for somebody to create a system and to deliver that system to you, but then you need to take accountability and ownership for what you've got. Because really, as traders, and you'll see this in the next slide that we talk about, that's how you're going to get the most out of what you're doing. If you don't want to put that work in, then you're not going to get what you want. Because remember, we talked about on the previous slide, if it is to be, it's up to me. So you as a trader have to do that work to get the results that you want. Otherwise, you're never really going to be able